Today, let's talk about the synthetic long strategy, how we can profit from stocks with less capital. So what is a synthetic long? A synthetic long is an option strategy that mimics owning stock. It has the same profit profile as owning the stock, which means when the stock goes up, the strategy gains value, and when the stock goes down, the strategy loses value. So what is the difference? As we'll see, a synthetic long can be created for much less money. But what is it exactly? A synthetic long is the combination of buying a call at a certain strike and selling a put at that same strike and expiration date. Typically, you would choose a strike that is the closest to the current stock price. This can be any date, but typically it is an expiration date that is far away. The long call makes it so that you gain value when the price goes up above the strike, and the short put makes it so that you lose value when the price drops below the strike. Because these are options, you are dealing with increments of 100 shares at a time. When buying a stock, you can buy any number of shares, but in this strategy, you are buying 100 times the number of contracts. Let's look at the graphs to see how it works. The synthetic long is the combination of the long call, which makes money above the strike, and the short put, which loses money below the strike. In this example, we're simulating that each of them cost $5. When we add those two together, we basically get the same line as a stock. It's worth nothing at the strike price, $50 in this case, and it goes up above it and goes down below it. But if it costs a net of $5 to open the position, in this case, if the call costs 10 and the put only brought in 5, then you get the same graph, except that your call is shifted down, which has the net result when you add them together is that your break-even price is shifted over $5. So it's like you're buying the stock at $55. The $5 that you cost means that you have to get that back and the price has to go up $5. Otherwise, you have the same straight 45-degree graph. So show me an example. If stock ABC is trading around $50, you would buy to open a January 2027 $50 call. At the same time, sell to open a January 2027 $50 put. Your strike will not match the price exactly, so one of your options will be in the money. In fact, one of the options will always be in the money. The call when the stock price is above the strike, and the put when it is below. How much does it cost? The cost of the synthetic long will depend on the difference between the strike price and the stock price, and also the general volatility of the stock. When volatility is higher, there may always be a cost to open the position. On a low volatility stock with a small difference between the two prices, the price can be almost zero. When the strike is below the stock price, you'll have to pay more to open the position. When the strike is above the stock price, you may even be paid to open the position. Some current examples. Take NVIDIA, which at this time was trading around $113. To open a January 2027 $100 synthetic long costs about $11.46 per share. So that'd be $1,146 per contract to open it. Apple, trading around $222, almost $223. Same January 2027, a 220 synthetic long costs about $16.32 per share. Tesla, trading around $287. Same January 2027 synthetic long at a 290 strike price costs $17.80. Volatility is high right now and the calls cost more than the puts. If you look at Ford, which is trading around $10, a January 2027 $9.85 synthetic long actually pays you 1 cent per share, or you may get it for basically zero. Ford has a lower volatility historically. Visa, trading around $349, same January 2027 $350 synthetic long, costs about $19.70 per share. So these prices are what it costs you to buy the call minus what you get for selling the put. Let's look at how I could actually place such an order. Here I'm logged into a Schwab account. I go up to trade, just on the website, trade, options. Let's go do the forward. If I choose forward as an option, here you have a whole bunch of different strategies. For the synthetic long, you have to choose the custom two leg. So you can just enter any two legs that you like. The leg is just one transaction. So buy to open, 1, we choose our expiration date. Let's go out to January, furthest one, 2027. And we sell to open. So they're both opening positions, which means we don't have something. We're not closing out a position. Choose the same expiration date. When you do custom, you can enter any date, so just be careful that you put the same dates and the same strikes, and this one is a put. We're buying a call and we're selling a put. So the price has changed somewhat from when I did my example previously. So here we can see the bid and ask and a midpoint, and for both the call and the put, and the sum of them. So when you're trading options, there's not really a fixed price. You make an offer. So you should always do a limit price, in my opinion. Otherwise, you're going to get the worst possible price. So here it's proposing the midpoint by default, and we can adjust that up or down. Maybe I don't want to pay quite that much. Let's say I want to only pay 4 cents, which is really only $4 plus commissions. And that may or may not go through. And it's valid just for today, a net debit. So this means I'm paying. It would be a net credit if I was making money from this, i.e. if the put price was higher than the call price. When I'm happy with that, I just click on review order. This account has no money, so I can't actually place it, but this would give you that, and you would say place order, and your order would be placed onto the market. The thing to note is that we're doing both of these transactions in one block at the same time. So either both will happen or neither will happen. And you really want to do them at the same time as opposed to doing 2 single orders, where one would be just buying a call and another would be selling a put. And you would be using those prices, 181 and 174, but one might go through and the other might not, and then the price could move, and you're not going to be in the situation that you want unless you're lucky. But you could be unlucky and pay more than you should have, or even end up with just half of the transaction. So that's what it looks like. So what are the benefits? The benefit of using a synthetic long versus buying stock is the reduced cost to profit from the same amount of stock. This is where leverage really comes into play. Let's say the stock costs $50 per share. To buy 100 shares, you would need to spend $5,000. If it only costs $5 to open the synthetic long position, it would only cost you $500. Another way to look at it is that you could buy 10 contracts and profit from 1,000 shares for the same $5,000 outlay. If the stock goes to 60, you'll make a $10 per share profit. The stock is worth 6,000, the call is worth 1,000. In the stock example, you make $1,000, which is 6,000 that it's worth, minus 5,000 you paid, off of a $5,000 investment. It's a 20% return. In the synthetic long case, you make $500, the $1,000 that the call is worth minus the $500 that you paid to open it, off of a $500 investment. That's 100% return, 5 times. Or you can make $5,000, $10,000 is the value of 10 synthetic longs, and $5,000 is what you paid to buy them, so you get $5,000 investment. It's still 100%, but you made $5,000 instead of $500. But If the stock goes down to 40, you'll lose $10 per share. In this case, the stock is worth 4,000. The put is worth minus 1,000, meaning you actually have to pay to get out of it. In the stock example, you lose $1,000. You're now down to 4,000. Off a $5,000 investment, you lost 20%, just the negative of what you gained. But in the synthetic long case, you lose $1,500. You have to pay $1,000 to close the position, and you already paid $5,000 to open it. Off a $500 investment, you lost 300%, triple your money. Or you lose $15,000 if you buy 10 of them. You just multiply all those numbers by 10. Also 300%. If the stock goes to 45, you'll lose $5 per share. Stock's worth 4,500. Your put is worth minus $500. Here, simple calculation, you lose 10% in the stock example. In the synthetic long case, you lose 200% because you have to pay 500 and then you've already paid 500. So you've lost 1,000 of a $500 investment, you lost 200%. Or again, you could lose 10 times that much. Let's say the stock costs $50 per share. To buy 100 shares, you still need 5,000, but if it only costs $1 to open the synthetic long position, it would only cost you $100. So in this way, you could say you could buy 50 contracts for the same $5,000 that you would buy to buy 100 shares, except now you're exposed to 5,000 shares. If the stock goes to 60, same example as before, you make the 20%. In the synthetic long case, you make $900 because you're worth 1,000, but you paid 100 to buy it. That's 900% return. So the difference here is that it costs you less initially to enter the position. Or you make $45,000, still 900%. Again, if the stock goes down to 40, you lose the same 20% in the stock example, but in this case, you lose $1,100, an 1,100% loss. Or you lose $55,000, which you probably don't want to do. So we can see that leverage can be a dangerous thing. You can make great profits, but you can also lose very big. It's very important to size your synthetic longs appropriately for your portfolio and risk tolerance. You don't want to buy as many as you can. Well, you want to be aware of what you're doing. You also have to remember the short put will use up some of your margin equity, so this will limit how many you can really buy. The more short puts you have, the more margin equity you will need to keep the position open. As the value of the stock drops, the margin requirement for this position will increase. There's potential for a margin call and being forced to close a position early. I'm working on a margin video, so look out for it. The downside to options is that they have an expiration date and don't last forever. This means that the price needs to move before the expiration for the synthetic long to make money. If the stock issues a dividend, you are not eligible to receive it, as you do not actually own any shares. This makes the strategy more interesting for a stock that do not issue dividends. How do you exit a synthetic long? You can exit a synthetic long by letting the options expire, be assigned, be exercised. One will always be in the money and the other out of the money. In either case, you purchase 100 shares per contract at the strike price. When the price is above the strike price, the put expires and the call is exercised. When the price is below the strike price, the call expires and the put is assigned. You pay 100 times the strike price to get the shares. You can then hold on to the shares or sell them based on what you think the stock will do in the future. If you made money, one thing you can do is sell enough shares to cover your cost and keep the rest as free shares. If you lost money, you can sell and take the loss, or hold on to them in hopes that they will recover. Another option is to turn to a covered call strategy to recover some of your money. But be aware, you could also be locking in a loss if the stock suddenly rises. You can also exit the position by closing one or both of the options. If the price is above the strike, you could sell to close the call to make a profit and let the put expire. You can also buy to close the put if you don't want to keep it open, if you don't want to risk you're exposed to a drop in the price and having to buy them. If the price is below the strike, you could buy to close the put to stop further losses. You can sell to close the call if it has any time value left, or keep it in case the price recovers. Depending on how long to expiration, how much of a difference, you can decide if you need to buy back the put or not. Thanks for listening.